They are turning the entire stock market on its head. That is not some wild rumor whispered behind closed doors. It is the exclamation echoing across conference rooms and trading floors as artificial intelligence platforms sweep through the world of finance. Could this be one of the biggest revolutions in modern investing? And should regular people rejoice or prepare for volatility like we have never seen before? Today, we are going behind the scenes of the new AI-driven battlefield, exploring how technology meant for the most elite quantitative funds is suddenly landing in the hands of anyone curious enough to try. In this episode, we will tackle the core questions. Will do-it-yourself traders, armed with data mining robots, reshape the stock market forever? And if so, how can entire portfolios be built within seconds by algorithms too complex for most to understand, but too tempting to ignore? Futuristic sounding? Absolutely. But, like it or not, artificial intelligence has already hurtled into the mainstream, promising to reduce insider advantage and flip the script on who truly wields power on Wall Street. We will discuss why this matters to you, me, and your next-door neighbor. We will explore how loyalty to well-known tech stocks like Tesla and Nvidia might give way to new, less obvious opportunities. Why cling to the same handful of megacorporations when an AI engine can sniff out hidden gems among thousands of overlooked equities? And, most importantly, are we stepping into a golden age of democratized prosperity, or opening a portal to a new wave of short-lived, hype-driven fads? People often talk about the unstoppable force of retail trading. As of now, everyday investors own roughly 25% of the entire United States stock market directly, and around 60% indirectly through individual retirement accounts and employer-sponsored programs. That means these non-professional players hold massive influence, whether they realize it or not. If you have always been intrigued by this unconventional community, made famous by their meme stock adventures and headline-grabbing loyalty to charismatic tech founders, then you have likely sensed a shift in the air. Indeed, many are noticing that retail investors no longer seem fixated solely on the so-called Magnificent Seven. These are the big-name technology companies: Alphabet, Amazon.com Incorporated, Apple Incorporated, Meta Platforms Incorporated, Microsoft, Nvidia, and Tesla, that have long dominated news feeds and captured the lion's share of personal trading budgets. Rather, the new wave of small-scale market participants are branching out, guided in part by advanced AI tools that can devour data far faster than any human mind. Kevin Xu, formerly known by the imposing nickname Sir Jack-a-Lot, used to be a classic retail trader addicted to heated online debates and the thrill of chasing hot tech stocks. But he has since launched a social platform called After Hour, designed to foster a more informed and less hype-driven approach to investing. Xu has seen firsthand how the culture of finance as entertainment can push newcomers toward risky speculative plays. Now, watching the emergence of AI-based tools that promise to analyze fundamentals, parse complicated economic indicators, and even readjust portfolio allocations in real time, he believes we have reached the dawn of a new era. As we unravel this bold claim, we will see that for many, the bottom line boils down to a simple question. If artificial intelligence can help individuals scan thousands of potential investments at once, removing human biases and knee-jerk reactions from the equation, might that actually stabilize the market over time? And if so, how? Of course, the largest AI breakthroughs initially benefited huge quant hedge funds, whose programmers hammered out code in secret. In that walled-off environment, advanced algorithms could sift through reams of metrics and place high-frequency trades at a pace no human can match. But now, with the cost of computing power plummeting, we are witnessing the next stage of AI's evolution: user-friendly services for the masses. One of the most talked-about resources is Cortex, a tool unveiled by Robinhood Markets Incorporated. Cortex aims to pick apart the data behind a given stock, generating simplified summaries that help an investor decide if a company is worth their money. While it might sound too good to be true, early adoption suggests that some novices are finding comfort in this streamlined approach. Robinhood's Vice President of Brokerage Product Management, Abhishek Fatepuria, claims that even more advanced processes, such as scanning option strategies, will be within reach for everyday customers. Next on the list, an emerging solution for Interactive Brokers Group Incorporated clients is Reflexivity, a platform that scours economic calendars, yield curve shifts, and individual equity movements to deliver timely alerts. Imagine you owned a slice of a transportation conglomerate. Reflexivity might ping you if Federal Reserve minutes suggest that an interest rate decision will ripple through the shipping sector. Alerted in minutes, or even seconds, you could make a strategic choice before the market reaction turned frantic. Jan Silagi, the mastermind behind Reflexivity, proclaims that we are on the cusp of 100 times difference in capabilities. That might sound like marketing buzz, but user feedback hints that the technology is as captivating as it is intimidating. After all, how do you keep your emotional impulses in check when a program can handle thousands of data points effortlessly, urging you to trust the machine? So, is that human element, intuition, instincts, that gut feeling, merely an obstacle to AI's cold rationality? Or does human nuance still hold value in a domain that can change direction in a heartbeat? This debate is not new, but the ground is shifting. For instance, among the more adventurous users, we have individuals like John Roskowski, a retail trader who dives deep into earnings transcripts and consults a generative chatbot named Grok for trading ideas. Roskowski's dream is to see AI scanning every corner of the marketplace for untapped value, undervalued options, or potential breakouts. The possibility of having a personalized system, one that learns from your specific goals and risk tolerance, feels tantalizing. Yet it also raises a series of ethical and emotional questions. If a bot screens the entire market within seconds and pinpoints a promising stock, what if that same bot is also used by thousands of others, effectively erasing the edge one might otherwise hold? The spread of such potent instruments inevitably drags cost into the spotlight. Until recently, protective barriers of expense and expertise kept most casual market players from dabbling in advanced analytics. Only the largest institutional investors with armies of data scientists could make use of these cutting-edge solutions. Then came DeepSeek, a Chinese developer widely credited with making AI-based trading innovation more accessible. By harnessing cost-efficient infrastructure, DeepSeek has allegedly lowered the financial bar for anyone seeking high-level computational resources. Suddenly, the dream of building your own hedge fund from your dining room table no longer seems far-fetched. But will it stay sustainable for the little guy, or is it only a matter of time before fees shoot back up? Enter David Lin, a former managing director at JP Morgan, who now champions the power of AI-driven investment. He set up Linvest 21 Incorporated to bring next-generation analytics to smaller institutions, accountants, and eventually the average retail trader. One of his hallmark products is AlphaCopilot, which allegedly can consume real-time figures and build entire stock portfolios on the fly. It is the kind of pitch that can get anyone's heart racing. Feed in your preferences, let the robots do their magic, and sit back while your investments are constantly monitored and adjusted according to the latest data. But is it foolproof? Skeptics caution that no algorithm, however clever, can break free from the unpredictability woven into global markets. One surprise corporate announcement or major geopolitical event, and those meticulously plotted risk calculations can get upended. Yet the allure is undeniable, especially for smaller funds or family offices wanting to appear more formidable than their lean staffing might suggest. That is one place where we might find a surprising benefit. Imagine a small boutique firm that once had to hire multiple analysts just to keep tabs on corporate earnings and essential economic trends. With an AI platform, the owners can scale up their analysis without multiplying their overhead costs. This effect might allow more specialized players to enter the scene, each with unique perspectives on market sectors that the big players sometimes overlook. Add to that the hopes of Kevin Xu and his network of more mindful traders, and you start to see the seeds of a broader shift. Could we witness a future in which the so-called crowded trades become less common, simply because AI platforms are guiding more investors to lesser-known companies? Before we go further, let us take a moment. If you are enjoying this deep dive into AI-powered investing, consider showing your enthusiasm by tapping that like button or leaving a supportive comment. Your feedback helps keep conversations like this alive in a digital world buzzing with quick sound bites. If you appreciate thorough explorations of hot-button topics, a little show of encouragement goes a long way. Now, back to our story. The Magnificent Seven currently represent roughly 30% of the top index in the United States, which can cause that entire benchmark to move sharply on the udders of just a few big players. But if AI can open up lesser-traveled paths for everyday participants, we could see a broadening of investment across different sectors, which in turn might soften some of the whiplash that occurs when one tech giant experiences a sudden downfall. Even so, do not assume a happy ending is guaranteed. If too many people rush into the same AI-driven picks, or if the underlying algorithms rely on similar data inputs, we could encounter new forms of herding behavior. Instead of piling into Tesla or Apple Incorporated, you might see thousands of smaller investors piling into a previously obscure niche, driving up the stock price well beyond real fundamentals. Another angle is the broader psychological impact. One argument goes that a widely distributed system of AI traders might reduce panic selling because the decisions would become more data-driven and less influenced by rumor or social media mania. The flip side suggests that the slightest glitch in the software could trigger chain reactions. If a popular platform mistakenly interprets a data stream as negative, it might instruct masses of users to exit a position immediately, magnifying a sell-off. Still, that scenario is plausible even without AI. Halting the contagion effect is a perpetual challenge for regulators and trading venues alike. From the standpoint of oversight, government agencies will have their work cut out for them. The wave of day traders who drove meme stocks to improbable heights last time around was a wake-up call that small investors can, collectively, tip the scales. But in a new environment where many are guided by advanced software, will that require an entire rethinking of how markets are policed? Additionally, who is accountable if an AI system inadvertently manipulates the market or shares faulty insights that cause big losses? These are not hypothetical problems. They are immediate priorities that weigh on policy discussions worldwide. Yet the same sense of unease existed when electronic trading emerged decades ago, and the market eventually adapted. We also have to consider potential winners and losers among companies themselves. Firms that operate in overshadowed industries might benefit from new visibility as AI platforms uncover them for under-the-radar traders. Conversely, leading brands that relied on being the default choice for many might see less automatic inflow of money if the crowd is guided to lesser-known, higher-growth opportunities. Kevin Shu suggests that the loyalty many small traders once showed to charismatic, high-profile founders might diminish, replaced by respect for profits discovered through measured analysis. That alone signals a cultural shift in how novice investors approach the market. But do not let these intangible shifts obscure the fundamental question of risk. AI might be able to visualize patterns mere mortals cannot see, but it is still operating in a realm where black swan events and irrational exuberance abound. The important part is that it puts an end to the sense of complete mystery that can frustrate new entrants to investing. If the tools can parse an earnings report or detect unusual supply chain disruptions, that might level the playing field between casual and professional participants. And that leveling is precisely what some see as the big game changer. It breaks down the walls of exclusivity that have traditionally surrounded advanced finance. We keep hearing about stock market democratization, a term that can sound like marketing fluff, but might hold some truth in these new developments. Remember that one widely repeated figure. Everyday traders direct about 1/4 of market liquidity. Now imagine that portion becomes more agile, with deeper knowledge. That alone could reorder the balance of power. Of course, we cannot ignore the possibility that as soon as something becomes widely available, it loses its uniqueness. If data analysis is cheap, then it is an arms race to find that extra insight the masses cannot see yet. In that sense, some cynics predict that the cycle will repeat. A period of advantage for average users, followed by a wave of new complexities, pushing the threshold further out of reach again. We do have glimpses of how adoption is growing. Reflexivity, for instance, has claimed that its weekly sales have tripled since the final stretch of the previous year, with interest spanning continents such as Germany, Turkey, and Brazil. The appetite is real, and it is global. For those on social media, the excitement is palpable. Chat rooms once filled with memes about going to the moon are now peppered with lines of code, plugins, and algorithmic hints. We are witnessing the birth of a new generation that sees little difference between gaming and trading, aside from the stakes. The social aspect has not vanished, but it is evolving, as communities exchange tips not just about which stocks to buy, but about which algorithm to trust. If all this talk of disruptions and unstoppable forces has kept you on the edge of your seat, now is the perfect moment to consider subscribing or following us for future discussions. We have more deep dives planned, and we would love to have you with us as we watch these dramatic changes unfold. In times like these, one of the biggest questions that surfaces is, will the market truly become more efficient? The classic definition of an efficient market is one in which prices incorporate all available information. AI tools might help bring that ideal closer, since fewer gaps remain in who can access and interpret massive data sets. That said, markets still revolve around human behavior. Even the best AI can only interpret data we supply, and inevitably, unforeseen global events can disrupt even the most precise forecasting. Nevertheless, if the entire ecosystem becomes more aware of a broader range of possibilities, perhaps that fosters stability. Sarah Hunt, a strategist at Alpine Woods Capital Investors, certainly appears to think so, highlighting that once ownership is spread more evenly, volatility in the biggest indexes might cool down. On the other hand, some of the old illusions about easy money and unstoppable gains will indeed fade when everyone has advanced analytics. If you can see that a stock is overpriced, odds are the next person building a neural network can see it too. That might limit those massive, spectacular gains that certain small traders once craved, though it could also reduce the shock of sudden collapses. There is a valid fear that fueling a generation of traders with real-time insights and predictive modeling might create false confidence. If you have ever seen individuals get lulled into a sense of invincibility by a streak of lucky trades, imagine that multiplied across a user base of millions, all trusting the same cutting-edge system. That might be where disciplined voice of reason figures like Kevin Xu come in. He envisions communities centered on genuine understanding rather than emotional hype. He sees AI not as a magic bullet, but as a guide to better decision-making. In that vision, new investors will no longer chase the next big moonshot. They will be methodically scanning overlooked industries such as emerging biotech, renewable infrastructure, or specialized software companies that typically do not capture the spotlight. And in many ways, that is the promise of AI for everyday traders. To find that knowledge once buried beneath piles of corporate reports, to interpret bond market signals, or to parse supply chain patterns that might predict a spike in raw material prices. Which leads us to perhaps the most critical element of all, how we handle the future. If the story of modern finance has taught us anything, it is that technology keeps evolving, but so do our collective temptations to outsmart or manipulate it. Regulators will need to adapt, trading platforms must remain transparent, and individual traders must resist the lure of get-rich-overnight illusions. Meanwhile, ex-traders like Kevin Xu or leaders like David Lin at Linvest 21 Incorporated are forging new roads, trying to ensure that these tools can be used responsibly and not just by large institutions. The big question remains, in 5 or 10 years, will we look back and see that this was the turning point when the average person gained genuine control of their financial fate? Or will it be just another fleeting chapter in the ongoing saga of hype-driven speculation? With the Magnificent Seven still looming large, but showing signs of losing their once unchallenged dominance over investor attention, the market is already giving us signs of transformation. Huge behemoths like Microsoft or Apple Incorporated remain robust, but the market mania that once revolved around them is evolving into something else, spurred by the democratizing power of data and artificial intelligence. People like John Roskowski, who once relied on little more than intuition, can now rely on generative AI to comb through reams of documents and highlight hidden clues. Where does that leave all of us? Optimists see a fairer game, while pessimists see a new reason for confusion in an already complex environment. Whatever conclusion you draw, the energy around AI-driven investing is undeniable. The simple fact is that the fundamental barriers, cost, complexity, speed, are being torn down. If these systems truly allow you to custom tailor your portfolio, exploring corners of the market you never knew existed, then we may be on the verge of an entirely reimagined financial landscape. The winners will be those ready to learn, adapt, and remain vigilant about the sometimes overlooked aspect of personal bias. After all, an AI can present you with data, but it cannot make you emotionally detached from the temptation of so-called easy wins. And that might just be the ultimate paradox. In a field newly shaped by logic-based bots, the human mind still stands undefeated when it comes to making the final call. Endings in finance stories are seldom definitive. We are dealing with a dynamic environment, a far cry from Hollywood scripts that wrap up neatly. Yet one thing is apparent. the line between professional and retail investing has blurred dramatically, thanks in large part to technological leaps in artificial intelligence. If you have listened this far, you now know just how massive these shifts might be, and how they could alter not only your portfolio, but the entire structure of the global economy. What we do with this knowledge, embrace it responsibly, or weaponize it for reckless speculation, will shape the investing world for years to come. Only time will tell whether AI becomes the great equalizer or simply sparks the next wave of market madness.